To enhance your knowledge on investments, we have our next session on how to invest in government securities. And who better to talk about it than a representative of our very own Reserve Bank of India. Please join me in welcoming Mr. Manish Tiwari. He is the Assistant General Manager at the Reserve Bank of India. He has over 26 years of experience in fixed income and money market trading, treasury management, financial market analysis and strategy, training and development, NBFC regulations and compliance. Over to you, Mr. Tiwari. The stage is all yours.
A very good morning to all of you, and I welcome all who have gathered here on this holiday, and especially the people from northern and northeastern state where there is a cold wave. Just give me a moment when yeah, now I think my PPT is being shared now.
Yes, we can see your PPT.
Yeah. Okay. So let's start the this particular session. We all talk about money, but this is one subject which is actually not taught money management in schools, despite a very, you can say, important need of it. Anyway, today we will. I have taken liberty to talk about investment in general, and then we will move to our main topic: what are the government securities and how to invest in them. So the first question is, why do we actually want to invest? Just think of it. And the answer is very clear. We are very much inspired by Uncle Scrooge. And we want to have lots and lots of money to do a lot of things. But then again, why so much emphasis on money? Is it just a new age fad, or is it some people say that it is a trick by banks, insurance, and investment companies so that people give them their money? But it is more than that. If we talk about the Panchtantra or Niti Shatak or Jatak Katha, Chanak Niti, Aesop's tale, hundreds and thousands of years ago also, money was considered something which is an essential part of life. So why not give its due importance to it? Why not save it and make a better future? There was a tale in Panchtantra. I won't go into that, but the gist of it was that the person was saving 25%, 1/4 of the amount for future, 1/4 was spending on his parents, 1/4 of family, and 1/4 on charity and pilgrimage. It is something which was written many hundreds years ago. Now, if you go to the wealth manager, they will talk of many numbers like rule of 72, 24, 10, 50, 30, 20. But what is this 50, 30, 20? Again, it says something about how to utilize the money. 50% should be, 50% of your income should be spent on your basic needs, 30% on lifestyle and luxuries, and 20% or more should be saved. Now we see a common thread here. These two things are hundreds of years apart, but the common thing is that at least 20 to 25% of the money you should save. And despite the score of stories, I somehow feel surprised that money management is still not part of any school syllabus or anything. And we cannot blame a particular generation for it. This is the environment where we go on, especially in India, that talking about money is considered something taboo. But we not only need to talk about it, we need to plan it. We need to plan our future on it. Why? We will see just in a moment. It is not only that why we want to invest. It is why do we actually need to invest? Right now, I think the majority of the audience is very young, but our responsibilities increases over time. Family, kids, medical needs, lifestyle changes, migration to other cities, good health, good education, quality living. They are not only, you can say, luxuries of life, they are necessity of life, requirement of it. Life is unpredictable. A job can change, can even become obsolete. There can be migration to a new city. It might be possible that after marriage, a girl moves to a city where the particular, if it is a smaller city, then jobs for that particular skill set are not available. One might be expecting a baby and get twins or triplets. One might purchase a house and it goes on into a legal trouble for next 20 years. Like many examples we have seen in recent time in media, there are buildings which were ordered to be demolished. So what happened? Investment is something which provides a kind of cushion against all these kinds of unpredictable events. And at the all, isn't living fabulously is goal of all our struggle. We study, we do a job. Why? So that we can live in a good environment. We can provide our family a good, you can say, a good education, a good lifestyle. Now talking about some deeper reasons, because inflation is a truth. Everything is going to increase in price over the time. Some may reduce, some may become obsolete, move out like radios, but overall inflation is there. Things are going to increase in cost and price. Demographics is changing. Number of people contesting for school seats, professional education, jobs, everything is becoming competitive. Cities are expanding vertically. More demand at one place and not a proportionate supply. Quality resources, schools, hospitals, residents, everything is becoming scarce. Jobs are becoming competitive. A normal degree is no longer the short guarantee of, you can say, a good job or promotion. Many people feel that after 5, 10, 20 years in job, they need to go for a very specific domain-specific course or senior management course. Companies are no longer able to fully take care of employees. In fact, in India, there were hardly few companies who actually tried to do for employees as much was needed. And then a social security infrastructure is not there as of now, a fully fledged. There are some things like some pension schemes, this and that, but not fully fledged. Like in, we heard stories like in US, people are working for up to retirement at 65, only to find that they cannot be debt free. They will need to work 10, 15 years more. Just imagine a person working till 80 years of age just to become debt free. And here is the money management and investment comes into picture. And why we need to invest at young age? Why we need to start investing at young age? There are only two reasons. One, every penny counts. It doesn't matter if you have a 5-figure like 10,000 rupees saving, only then you can start investing. Start investing with anything you feel comfortable with. Like in childhood, we used to have this gullak. And we used to put quarter, half a rupee, and magically it used to become like 100, 200, 500 rupee over a period of a few months. Just imagine that happiness, which we felt at our childhood. And second, compound interest is magical. You invest, you get profit, you reinvest, and it grows. It grows magically and exponentially. And also at the same time, compound interest is cruel when it comes to loans and other things. Like in this COVID period, which was completely unexpected. In this period, many people miss some EMIs, like 3, 4, 5 EMIs. But when their loans get restructured, they had to pay 10 to 20 EMIs extra. They missed 3 to 5, they are going to pay 10 to 20 EMIs extra. Just imagine what happened to someone who missed 1 year of EMI payments. So compound interest works both ways in a very powerful way. Make it work for you. Start investing early, reinvest that profit, and let your amount grow. There are many kinds of investments. Like you can say there are stocks, there are mutual funds, there are bank FDs, share market, there are bonds, corporate bonds, as well as government bonds. There is insurance. Well, for insurance, I'll say that I do not consider it personally. It's my personal opinion. I do not consider it an investment. I'll say that take the good term insurance policy, take a good medical insurance policy, and consider it necessary expense. The stock market is highly volatile. Just many of you must remember what happened in 2008. Then in early 2020, the stock market plummeted, and many people who were heavily invested in mutual funds or in stock market felt a kind of, you can say that some of them had to realize loss because of need of money. Some felt very bad, and some people couldn't even survive that stage to a very good, in a very good manner. So that is where the diversification come into picture. What is diversification? It is simply to spread your investment amount in more than one asset class. Or you can say, in other words, it's a way to minimize risk. As the old adage goes, do not put all your eggs in one particular basket. So that is diversification. You have different asset class, you will distribute your investment amount into different classes. They are stocks, debt securities, cash, real estate, or if you cannot right now spend in real estate, you can go for real estate mutual funds. I think there is a lecture on mutual funds also today. So this thing will be taken care at that time. Now, this is something very, very useful. This is a research of 10 years on different asset classes, the return on different asset classes: equity, that is stock market, gilt fund, government securities, liquid funds, bank FDs, etc., gold, and average. Now, there have been at least 40% of time where the government securities have outperformed the stock market. And in this particular time period, 3 out of 5 years, 3 out of last 5 years, gold has given a negative return. So that is why you need to spread, because what is going to actually grow next year or next to next year or in future, it cannot be speculated at the moment. It will change based on the reality of that particular time period. Now, how to diversify or spread this capital? You can, first thing, diversify between riskless and risky investments. Then diversify between different asset classes, then diversify in each asset class what you actually want to invest. Now, what are risky the asset classes and what are risk-free? Let's see. Stock market, definitely a risky proposition. Mutual funds, again, part of stock market. Gold, as we have just seen that 3 out of last 5 years in that particular research period, it has given negative return. Real estate, again, it cannot be said that it will always grow. Bank deposits, including FDs, up to 5 lakh rupee in one particular bank is insured. Above 5 lakh, again, that is not that risk-free, but we can say that the banking segment in India is comparatively stable, especially in when we talk about some big banks. Corporate bonds, they are companies who issue bonds for some period, but what happened to those particular bonds? Sometimes companies actually go bankrupt. Insurance, again, I'll not count it as an investment, but yes, it is one of the asset class. Now comes the government securities. Government securities are near risk-free investments. Why? So now here we start our main topic. What is a government security? It is basically a bond. A bond is simply an agreement between a borrower and a lender. A borrower is someone who issues the bond, like a corporate, a government, or a municipality in some particular countries. And borrower can be anyone, like a company, NBFC, bank, even an individual. In fact, India is one of those rare states where individuals have access to both primary market and secondary market as far as government securities come. Basically, a government security is a tradable instrument issued by either a state government or central government. It is issued to fulfill, you can say, to finance particular projects or some schemes. Central government in India issues treasury bills, and what are treasury bills we'll see in some moment, in a moment, and government securities. It practically carried no risk of default because it is in a way, it is issued by the central government or state government. So it is insured to a very great extent. And central government securities are actually called risk-free gilt-edge instruments. Now, why you should invest in the government securities? Like compared to cash or gold, holding government securities is easier. You get your interest every 6 months. It provides the maximum security because of sovereign's commitment, can be held in dematerialized form, available in wide range of maturities from, you can say, 91 days. In fact, they are less than 91 days to as long as 40 years. There are government securities which are maturing in 2061. You invest for one time, you get that interest for next 10, 20 to 30 years, depending on which security you are buying. And one more thing, compared to the comparable instruments like FDs, etc., they give better yield, especially the longer term securities. Can be sold in secondary market to meet cash requirement, can be used as collateral. And central government securities and treasury bills are quite liquid. So you can always sell in secondary markets. Now, what are the types? There are 5 types. One, dated central government securities, treasury bills, cash management bills, sovereign gold bond, and state development bond. Dated government securities are the securities which issued by central government for the different tenures like 5, 10, 20, 30, 40 years, even in between. Like this example, 667 GS 2050. 667 is the interest rate at the time of launch. GS is central government security, and 2050 is its maturity date. Then there are treasury bills issued for 91 days, 182 days, and 364 days. These are some examples. I will show you on the website, their yield, etc. Cash management bills are simply like to treasury bills, but issued for less than 91 days, like 84 days, 10 days, 29 days, etc. Sovereign gold bond is something which is very unique. It is perhaps one of the, in fact, not perhaps, it is the best substitute to invest in gold. Because when you invest in gold, you are actually paying many of the charges. While investing in sovereign gold bond, you are not paying those charges, like making charges, like taxes, etc. These are issued in 1 gram of gold, and a person can invest up to 4 kilograms per year. So it is a huge amount you can invest in that. Tenure is usually 8 years, but can be sold after 5 years. And you also get a 50 rupee per gram discount compared to physical gold. And they also give you an interest. It is just not that you are buying gold and selling gold. You are also getting a particular interest on them per annum. And then there are state securities issued by state governments. There are 2 types of the issuance in 2 types in which government securities are being traded in India. One is primary issuance, which happens on weekly basis. You can get calendar on RBI website, and then secondary market. These are some yield. As you can see that currently the 25 years and above, the last 2 rows, the yield is nearly 7.16 to 7.3%. Whereas the FDs, the maximum yield you are getting is 5.25 to 5.6%. And if you go for a smaller tenure, then it is like 2.9%, 4%, or something like that. Now, take these 2 examples. What happened? You invest in FD for 5 years at 5.25%. You invest in 30-year government security with 7.2% coupon. After 5 years, this difference will come. Like the interest you will earn on FD will be around 29%, and the interest you will earn on this security, if you sell after 5 years, will be 42%. On the premise that you are reinvesting the coupon. Now, what happens if there is some need and you actually need to sell the security after 6 months? Banks will actually penalize you for that, and the actual interest you will get will be only 3.4 to 3.8%. Whereas a government security, if you sell after 1 week, this particular security, if you sell after 1 week, if you sell after 6 months, if you sell after 30 years, you will get the particular interest on which you have purchased it. That is in this case 7% plus. Now, gold bonds versus physical gold. The quantity of gold which which an investor pays in the sovereign gold bond remains protected. For example, sometimes we buy particular gold from a jeweler, and when we go to sell it, they say then now though we have to deduct this much charges, deduct this much making, deduct this much dust, then GST, and then other things. Then the physical gold, there is always a fear of theft or robbery, while SGB always remain that. So if someone is really thinking of investing in gold, then SGB is perhaps the best option there is. Now, how to invest in government securities? There are debt mutual funds, which is a passive way. They are stock market, but only I think 4 or 5 securities are available. And then in November, RBI launched this RBI Retail Direct Scheme. What is it? It's a, you can say, a one-stop solution to buy and sell all kind of government securities in India. You can open a retail direct guild account directly with RBI and invest through it. You can invest in the primary issuance. You can access the secondary market through NDS Home. These are the 3 websites where you will get all the information. rbi.org.in, that is RBI website. You will get the calendar. You will get the auction announcement. You will get the auction results. Then CCIL India, you'll get all kind of information through that. And the RBI Retail Direct. Let me show these 3 websites to you. Just a moment, which one I am sharing. New share. Yes. This is RBI website. You go into the press releases. You'll get all results of 91 days, 120 bill auction, etc. You'll also get auction of Government of India dated securities. You'll get announcement and everything. Then CCIL India website. You go into this particular segment, that is research. Go into CCIL publication market update. You'll get weekly information of what is the yield, everything like this 30-year security. It is getting a yield of 7.22%, 7.23% right now. There is 40-year government security getting a yield of 7.23%. Compared to the bank FDs, they are actually quite good. Then again in CCIL publications, there is something called their monthly magazine Rakshitra. You'll get hell lot of information in this particular magazine, all kind of securities, their issuance, their history, their current yield. And now we come to our main feature, RBI Retail Direct website.
Welcome to RBI Retail Direct, the first of its kind initiative by Reserve Bank of India. RBI Retail Direct is a one-stop solution for all individual investors to invest in government securities. You can now invest in central government bonds, state government bonds, treasury bills, sovereign gold bonds. For the first time in India, investors can access primary and secondary markets for all these instruments. Reserve Bank of India Retail Direct is a retail investor-friendly, UPI and net banking-enabled online platform. Open and maintain a Retail Direct Gilt account directly with the RBI. Participate in primary issuances and trade in the government securities secondary market without any intermediary. You can now invest safely. Choose a maturity period that suits you best. Get stable returns and have the added freedom to enter and exit your investments as per your needs. You can open an account and trade free of cost. All of this is backed by a trustworthy and stable infrastructure. If you are an investor looking to diversify your portfolio, seeking stable returns, and contributing to nation building, then RBI Retail Direct is the solution you need. Participate, invest, trade with RBI Retail Direct. To learn more, log into the online platform now.
So this is the RBI Retail Direct website. If you go into this particular segment tour.
Welcome to RBI Retail Direct.
Just a moment. You'll get all kind of the information, bond basics, types of government securities, factors affecting them, their yield, price yield relationship. There are videos on all. Then there is a good tutorial on how to log in the website, how to place your bids, how to withdraw bid, how to view your allotment, your holdings, the coupon data, redemption, everything, and also for the secondary market. Register for NDS home, set your market watch, placing order, everything. So all kind of the government securities issued in India are available for investment and trading on this particular platform. And let me tell you, there are hardly a few nations in the world which provide this kind of access to primary market as well as secondary market to retail investors. So this, someone who wants to diversify the portfolio, who wants to invest in government securities, this is a one place solution available to you. So this is my entire presentation. I have rushed it because I wanted to cover too many things. If there are any questions, obviously, please leave them. And I will be able to try to give the answers to as many as I can. Thank you.
Thank you, Mr. Tiwari. This was absolutely amazing. So many concepts, so much clarity. With the growing ease of investment, now government security should be considered by more and more youth as an option, moving forward. Thank you very, very much for sharing these valuable insights, Mr. Tiwari. Our audience does have some questions, but in the interest of time, it'll be great if we can email them to you and, we can take them up and communicate your answers back to the participants.